Something is quietly shifting inside the 2026 housing market. Mortgage rates have eased from recent highs, but home prices remain elevated. Inventory is still tight in key cities, and investors are no longer rushing blindly into deals. They are recalculating. This is not a crash. It is not a boom. It is something more strategic, a reset. In the past few months, 30-year mortgage rates have drifted closer to the low 6% range after peaking higher in 2025. That small percentage change may look minor on paper, but in real numbers, it can mean tens of thousands of dollars in buying power. For investors, that difference changes everything. It changes cash flow projections. It changes refinance timing. It changes acquisition strategy. And most importantly, it changes who wins in this market. The question is not whether rates will fall further. The real question is this: are you positioned correctly for what comes next? Because in every housing cycle, there is a quiet window where disciplined investors build long-term wealth while others hesitate. And in 2026, that window may already be opening. Today, we break down what is really happening, why this shift matters, and how serious investors are responding.
To understand the 2026 housing reset, we need to start with mortgage rates. In early 2026, rates eased after remaining elevated through much of 2025. While they are not back to historic lows, the shift downward has improved affordability slightly. That matters because housing affordability is the single biggest driver of buyer activity. When rates rise, buyers disappear. When rates stabilize or dip, confidence slowly returns. But here is the important detail: affordability is still strained. Home prices in many regions have not fallen significantly. Inventory remains historically tight. Many homeowners are locked into older loans below 4% and refuse to sell. This creates a supply freeze. Fewer homes on the market means competition stays firm in desirable areas. So what we are seeing is not a demand explosion. It is selective demand returning. Investors are focusing on markets with strong job growth, population inflows, and stable rental demand. Instead of chasing appreciation, they are prioritizing cash flow resilience. This is a structural change in investor psychology. In the low-rate era, investors relied on rapid appreciation. In 2026, they are underwriting conservatively. They are stress-testing deals at higher rate scenarios. They are factoring slower rent growth. They are preparing for volatility. This shift marks the beginning of a more disciplined cycle.
Now let us go deeper. The real story of 2026 is the two-speed housing market. Some regions are seeing price stability and rent growth. Others are experiencing longer listing times and mild price corrections. This divergence is absolutely critical to understand the current landscape. National headlines rarely tell the full story. As the saying goes, all real estate is local. In high-growth metro areas with strong employment pipelines, demand remains firm. Meanwhile, in overheated pandemic boomtowns, supply has increased and pricing power has weakened. Investors who understand this divide are positioning carefully. They are targeting mid-sized cities with diversified economies. They are analyzing rental vacancy trends. They are watching wage growth closely. Another major factor shaping 2026 is new construction slowdown. Builders reduced activity when financing costs surged. That means future supply could remain constrained. If rates decline further, pent-up demand could return quickly while inventory stays limited. That combination can stabilize or even lift prices again. Institutional investors are also recalibrating. Large funds are not exiting real estate. Instead, they are negotiating harder, focusing on yield, and waiting for clearer monetary signals. This behavior signals caution, not collapse. In short, the housing market is not breaking. It is adjusting to a higher rate reality while preparing for the next phase.
Consider two investors in 2026. This period marks a critical shift in how wealth is built in real estate, separating the reactive from the strategic. Investor A waits for headlines to declare a crash. They are paralyzed by the noise, waiting for dramatic price drops that never fully materialize in strong markets. Investor B studies numbers quietly. They identify a growing metro area with steady job expansion and limited new housing permits, focusing on fundamentals over fear. A property that barely missed cash flow in 2025 now works because rates dipped slightly. The payment difference improves annual returns significantly. Investor B negotiates below asking price due to longer listing days. They understand that time on market is leverage, not a warning sign. Rents remain stable because vacancy rates are low. This creates a predictable income stream that forms the bedrock of their investment. Over time, modest appreciation compounds on top of consistent rental income. It's a slow build, but it's mathematically inevitable. Meanwhile, Investor A remains on the sidelines. They are waiting for a bottom that isn't coming, while the cost of entry slowly creeps higher. This example reflects what disciplined investors are doing right now. They are not predicting extremes. They are executing based on solid market fundamentals. Another example involves refinancing strategy. Some investors who purchased at higher rates are watching bond markets closely for any signs of relief. Even a half-point rate improvement could justify refinancing, lowering monthly costs, and increasing portfolio cash flow immediately. These micro-adjustments separate reactive investors from strategic ones. It's about small wins that compound into massive portfolio advantages. In 2026, the question isn't if you should invest, but how you analyze. Stay disciplined, stay data-driven, and keep moving forward.
So what should serious investors do in this 2026 housing reset? First, focus on cash flow durability. Do not rely solely on appreciation projections. Stress test your numbers. Second, track local supply data monthly. Inventory changes can shift negotiating power quickly. Third, prepare capital reserves. Liquidity provides flexibility when opportunity appears. Fourth, monitor Federal Reserve signals and bond yields closely. Mortgage rates respond to these indicators. Fifth, build relationships with local lenders and agents. Off-market opportunities increase when markets slow. Finally, think long-term. Real estate wealth is built across cycles, not within headlines. The investors who thrive are those who remain analytical while others react emotionally. 2026 rewards patience, research, and disciplined execution.
The 2026 housing market marks a turning point, a period defined not by volatility, but by a fundamental recalibration. For the first time in years, affordability is showing signs of life as wage growth finally begins to outpace home price appreciation. National home values are forecasted to grow at a modest pace of 1 to 4%, reflecting a return to historical norms. Mortgage rates have transitioned from a source of panic to a point of stabilization, settling into the low 6% range. Buyers are increasingly accepting this new normal, allowing for a slow but steady rebuilding of market confidence and sales activity. Supply remains tight, but a gradual increase in new construction is helping to release years of pent-up demand. We are seeing a significant shift in household composition, with a rising demand for multifamily units and solo living spaces. The median age for first-time buyers has reached a record high, as shared housing and rental flexibility become strategic choices. While the Sunbelt remains popular, regional markets in the Midwest and Northeast are attracting attention for their stability and affordability. In this environment, success is not found in quick flips or speculation. It is built through long-term strategy and data-driven decisions. Alternative sectors, such as logistics, data centers, and senior living, are offering resilient returns for the analytical investor. Focusing on value-add renovations with faster timelines can reduce exposure to market fluctuations and build equity faster. Artificial intelligence is now moving beyond simple advice, automating routine tasks and streamlining the entire buying and selling process. Climate resilience and insurance costs are now central to property value, as buyers prioritize long-term sustainability and risk reduction. The broader economic context, stabilizing inflation and a neutral Fed policy, is creating a more predictable landscape for market players. So, where does this leave us as we navigate the months ahead? The housing market of 2026 is a study in discipline. The 2026 housing market is not defined by panic or euphoria. It is defined by recalibration. Mortgage rates have eased but remain elevated compared to past years. Supply is tight in strong markets. Investors are becoming more selective. This environment does not reward speculation. It rewards strategy. The opportunity window is not loud. It is subtle. And those who recognize it early can build steady, durable wealth. If you are serious about mastering real estate investing and understanding market cycles before the headlines shift, subscribe to WealthWise Insights. Stay informed, stay analytical, and position yourself ahead of the next move. The reset is here. The question is whether you are ready for it.
If you found this video helpful, please like, share, and subscribe. Thank you for watching.